Silver has just gone through one of the most aggressive melt-ups we've seen in decades. In early 2025, silver was trading near $29 an ounce. Just 1 year later, prices surged to as high as $120, a roughly four-fold increase in such a short period of time. Moves like this are very rare for silver. In fact, there are only two real historical comparisons. The first time was a 3-year stretch from 1977 to 1980, where silver prices rose more than tenfold. Another 3-year stretch from 2008 to 2011, where prices jumped by roughly 400%. In both episodes, price went parabolic, and investors rushed in aggressively to this asset just like today. If this rally were to follow a similar 3-year pattern, it would suggest there may still be room to the upside. But silver almost never moves in a straight line. It trades in cycles, and in both 1980 and 2011, those rallies ended with collapses just as violent as the run-ups. And more recently, we've already seen how quickly sentiment can shift. After its latest surge, silver experienced one of its largest single-day declines on record, losing almost 30% of its value. That's why we need to understand exactly where we are in the cycle. And with silver now trading far above its previous peaks, bubble warnings from analysts are starting to resurface, which means the possibility that this cycle is closer to its peak cannot be ruled out. And there are some data that supports this. Take this chart, for example. It shows trading volume in SLV, one of the largest silver-backed ETFs in the world. In just 5 trading days, from December 25th to December 31st, 2025, more than 577 million shares were traded. That's an extreme spike, and it's only happened twice before in SLV's history, once in 2011 and once again in 2021. If we overlay silver prices on top of those volume spikes, both periods line up almost perfectly with local tops in silver. When volume explodes like this, it's usually a sign that everyone is rushing into the same trade, and when that happens, there's often not much new buying power left to keep prices moving higher. Crowded trades makes the market more fragile and susceptible to pullbacks. However, it's unfair to just see silver from this angle. See, silver isn't primarily a financial asset. At its core, it's an industrial commodity. That means its price doesn't just respond to investor sentiment, but ultimately responds to supply and demand, just like oil, copper, or lithium. Roughly 60% of global silver demand comes from industrial use, while investment demand makes up closer to 20%, and there's a strong case that this industrial demand could continue rising. Silver plays a key role in several of the fastest growing sectors: solar panels, electronics, semiconductors, and electric vehicle infrastructure. Over the past decade, silver demand from these industries has increased by more than 60%, and looking ahead, those same factors are expected to expand further as electrification, data infrastructure, and renewable energy continues scaling up, which could be a tailwind for silver. And it's not just demand pushing silver higher. At the same time, the supply side is under real pressure. 2025 marks the 5th consecutive year of silver deficits, or in simple terms, the world is consistently consuming more silver than it can produce. Right now, demand is running around 100 million ounces above global supply. Silver production has struggled to grow, partly because most silver isn't mined on its own. It's produced as a byproduct of other metals like copper and zinc, which means supply can't respond quickly when silver demand surges. We saw a very similar setup heading into the 2008 to 2011 silver bull market, where demand consistently exceeded supply. And it's also what drives the 1970s silver melt-up. Back then, the silver market was also running deficits of roughly 100 million ounces per year. It's basic supply and demand law. When demand keeps rising and supply can't catch up, prices are forced to do the balancing. However, relying on supply and demand imbalances alone to justify a bull market can be risky. For example, an economic slowdown could reduce industrial demand for silver and potentially push prices lower. Deficits also don't guarantee rising prices. Between 2011 and 2015, the silver market recorded total deficits of around 100 million ounces, according to the Silver Institute. Yet, silver prices still dropped by more than 60% over the period. When we dig deeper, there's one other factor that's mattered most in every sustained silver cycle. In fact, every major silver bull market has shared the same macro backdrop: a weakening US dollar. In the late 1970s, the dollar was losing purchasing power rapidly, and silver rose tenfold in response. Then, in the 2000s, aggressive easing from the Federal Reserve pushed the dollar lower, and once again, silver entered a multi-year bull run. In those environments, investors didn't just buy silver because of supply constraints. They bought it because they were looking for protection from currency debasement. And conversely, when the dollar strengthened, like in the early 1980s and between 2011 and 2015, silver prices collapsed. Capital moved out of hard assets and back into cash because holding dollars once again made sense. That brings us to today. Over the past year, the dollar has fallen by more than 10%, and that weakness has clearly been one of the key forces behind silver's surge. If this silver bull market is going to continue in a meaningful way, it likely requires the dollar to keep weakening from here. One thing that could push the dollar even lower from here is a shift in Federal Reserve policy. Periods of Fed easing have almost always been followed by dollar weakness, like we saw in the early 2000s, 2008, and in 2019. When the Fed cuts interest rates, the return investors earn for holding dollars falls. Investors start looking for return in assets like equities or commodities, which naturally puts pressure on the dollar. If the Fed continues to ease from here, we could potentially see the dollar weaken further, which could be supportive for hard assets like silver. Ultimately, supply-demand imbalances and a weak dollar are the key conditions that need to remain in place for silver prices to keep rising. But as history suggests, if even one of those pillars breaks, silver has a long track record of unwinding just as violently as it rallies, which is why close monitoring is important. At Capital.com, we'll continue tracking the macro forces behind commodity markets and what they mean for investors navigating this cycle. Thanks for watching.